The next panel is the eagerly awaited topic of ship finance in the post-COVID era. Moderating the panel is my good friend Brian Devine, a partner and head of transport in the United States for the international powerhouse law firm of Norton Rose Fulbright. His panelists today are Dan Carr, head of asset finance for National Australia Bank, Shreyas Chipalkatty, global head of shipping, logistics, and offshore for Citi, Paul Leand, CEO of AMA Capital Partners, and Martin Lunder, managing director of Nordea.
Thank you for the introduction. I really appreciate that. It saves you actually the pain of me reading a very monotone list of bios. So I hope to keep this conversational, and I do invite the panelists to join in. And if you see so fit, with the exception of myself, please feel free to criticize each other. So I think let's just jump right into it. I mean, over the past year, I'm just curious, and I'll open this up in a conversational manner to the whole panel. What kind of deals are you guys seeing? I mean, Martin, would you like to start off on that?
Sure. Thank you. Thank you for the introduction. I think that when we looked at the volume for 2021, we clearly see it was down from 2020 about 20%. And I think the reason for that is, of course, the volatility from the pandemic, and that many companies have held off a bit on large capital investments, which really drives our, senior debt volumes. But however, we have seen that maybe the core shipping banks, they have reserved their capacity for their key clients. And we have seen some transformative deals done for like a Genco and an Eagle Bulk at terms that are, pretty good. Now, I think what we do see is lower leverage, more focus on the age of the collateral, and also on AER trajectory, i.e. the Poseidon principles. We are focused on those. We project a bit on what we can expect from the deals we do. Margins are a bit all over the place, and I think that's driven also by the fundamentals, meaning that some of the segments have seen fantastic, results, and that has given their financial parameters, a boost, and they're looking very strong, while others have struggled a bit with, revenues during the past year. And that's why we see margins all over the place, really. We're looking at a bunch of opportunities right now, but still, I think it's too early to say that we are roaring, hence the name of the conference, So if that's helpful.
I think it's fair. We are coming out of some real unprecedented times over the past couple of years. And if you told me 2 years ago we'd be doing as well as we were then, with the exception perhaps of, say, cruise and or tankers, I'd be shocked. So I do invite the others. It's a pretty broad question, and I would be curious for some input from the others on their views.
Perhaps from NAB's perspective, I tend to agree. I think it was a mixture of sort of large traditional full recourse type loans that we were seeing for the most part. Then the NAB's perspective, we were involved in those. We were also involved in pushing the needle a little bit on the sort of non-recourse structuring as well. NAB has got a big strategy of supporting global sponsors around the world. And what we're seeing is that the global sponsors are looking for increased yield. And at the moment, they're certainly finding that in the shipping space. And we've been structuring and able to close deals on a non-recourse basis for those existing sort of sponsor relationships with the bank. In terms of the pricing for those deals, again, they are all over the place a little bit, I would say. Certainly depends on the length and of the terms of the underlying contracts that are involved. So if there's a shorter term contract in place, then the margins will almost certainly higher. And if it's a sort of a long-term offtake arrangement with an oil and gas major, for example, then the pricing certainly comes in to reflect that. And then in terms of leverage, LTV, again, it's sort of similar principles as the pricing, really. If it's a spot-orientated asset, it tends to be a lower LTV, and if it's fully contracted long term, we can tend to go a bit harder on the leverage.
And Shreyas, I don't know if you had anything from Citi's perspective to add.
Yeah, thanks, Brian. Look, I think for us, it's really been container shipping and LNG, two highlights of the year. A record year in terms of activity, no complaints there. But I think we're coming to the maybe the middle or the beginning of the final act of asset finance, traditional asset finance in shipping, because the question looms before us the next decade. What happens to midlife assets? Will banks be able to finance them because they'll be under increasing ESG pressure on their portfolios from regulators and from the public? And how does that translate to, charterers, how they react with charter rates? Are they willing to pay more for greener ships? All of this is ahead of us, right? And we don't have the answers. So I think what we've been doing all this time, the last 30, 40 years, this is, I think, the final act. We are right in the middle of it, and we don't know what's going to come next.
Sure. Well, we'll definitely dive into some of those issues a bit deeper over the next half an hour or so. Paul, do you have all the answers, please?
Do not have all the answers. Although I do have a question, and that is, did Fauci actually agree to the proposed name of this conference, that the post-COVID? Is he actually signed off on post-COVID? Or I don't want to get anybody on this panel in trouble having inadvertently taken that position.
We're cautiously optimistic. Boris Johnson said we are, so we're good to go.
There we go. So long as we broadcast this in the UK and not the US, we're good. Look, I think that first of all, I think it's been an interesting time because you've seen, in our view, a confluence of IMO 2020 with the with the pandemic as well as what has continued to be an exit of a lot of the traditional shipping banks, an exit that really started probably 5 or 6 years ago and has continued to this day. I think that you've also seen a real, whether or not you want to say pricing's all over the place, the one thing I will say is it's demonstrably higher than it was 5 or 10 years ago. This is an industry that historically was noted for having investment grade pricing for investment grade lenders or borrowers, and I think that has corrected. It's taken decades to do, but it has corrected, and I think you still see it today. So even the more aggressive deals that you see out there are still at demonstrably higher pricing than it has been in the past. I think the other thing that we've seen is just a comment on the overall market, and that is it's not as deep as it used to be. And I think when you start to go to these markets and you start to pick up that, when you need to fill out that syndicate with the one additional lender or two additional lenders, those are typically now not folks that have spent a lot of time in the shipping industry. And so I think one of the things that's going to be very interesting as you move forward, as inevitably, and I hate to remind everybody, inevitably shipping does go into down cycles, and they do require some work. How are those new banks going to react within that broader syndicate? And is it really going to be worth it to have brought in that marginal bank to fill the syndicate to get the more aggressive terms that you saw at that point? But overall, I think that it's remained a healthy market for the better borrowers out there. But I do think you're seeing that bifurcation.
Sure. Well, to that point, I mean, you mentioned the new banks, perhaps, and again, if others have views on new banks coming to the market, feel free to comment. I guess the question is, will it be necessarily new banks in the traditional fashion that we all kind of grew up with and are familiar with? Or, I mean, I had perhaps from my provincial New York perspective, we had been expecting to see a much more Asian money coming into the markets. I don't necessarily think I've seen as much of that as we thought we would have over the past couple of years. What I have seen, I think, is a renewed interest by U.S. funds, and I just don't know if others have views on that.
I think, as Martin said, right, volumes are down, which means that banks which are already active in the space are defending their territory and have more firepower to churn. They are selectively churning. They are pricing better, as Paul said. And I think that's really where we are. We have a situation where people aren't really building new stuff inside. It's really about consolidating and making sure that people are set up for the future, whatever that may be. There's a bit of nervousness out there, isn't there? I mean, we don't know what to build. We're trying to buy vessels that are midlife. Some of them, some sale and leaseback activity. It's all a mix. There's no clear direction. And in that environment, when banks are defending their portfolios, doesn't leave much on the table for new banks to come in for, unless, as Paul was saying, you add a bank to achieve some kind of specific objective. And that's probably what's going on at the moment.
Brian, I think one of the markets which appears to be opening up to shipping at the moment, aside from US funds, would be the Japanese operating lease market. I don't know if any of the others have noticed it, but I think there's a sort of a bit of a void in activity amongst the JOLCO investors that's been left by aviation. They sort of backed off aviation a little bit, left the gap for shipping, and some of the large US borrowers have sort of taken advantage of that opening up of the JOLCO market. From a bank market, I just noticed that some of the deals that we partnered with other banks on in the Japanese operating leases were able to sell down to sort of smaller Japanese banks that I hadn't seen before in the market. I think that sort of JOLCO angle was key to that.
Yeah, I think I agree with you, Daniel. What I've observed and I find interesting is that I have seen some of our traditional borrowers actually use the sale-leaseback market, particularly funded by the Chinese institutions, and it seems to be that when you have we spend a lot of time looking at the age of ships, and as Shreyas saying, there is uncertainty because our uncertainty is, how comfortable are we with a 14-year-old ship in our portfolio for a 5-year loan? Are we okay with that ship being 19 at maturity? What has happened in those 5 years? And that's a discussion point, and I think we spend a lot of time and we look at, and the answer is different for different clients. Some of the really strong companies, probably we are more flexible, but if it's a weaker company or more project-oriented, age becomes a much bigger issue, as well as AER trajectory. But what I have noticed is I see that some of our core clients are able to place financings in the sale-leaseback market at terms that aren't terribly different than senior debt financing in terms of margin, but longer tenors and more flexibility on age. But I still think that what with the feedback is we get that if the bank market is competitive, the borrowers do prefer traditional bank financings because they know the characters that are involved, and they know if they need to do amendments and changes, it's a process that can be relied on in terms of long relationships and etc. So, but it is very interesting because right now we're looking at some larger transactions. We're looking at how do we fill them, and there's a core cadre of banks that we fill them with. But then the question is, who do we go beyond this cadre of core banks? Who are there to do a deal in today's shipping market? And I think I agree, Shreyas. We're in the beginning of something very uncertain here.
Well, speaking of uncertain, I mean, obviously we have an interesting geopolitical situation kind of going on right now, and that will be covered in other panels regarding geopolitics and their effects on shipping. I am curious, however, I mean, Shreyas, if I could trouble you again on this one. For start, I know Citi is everywhere, obviously, and puts out various different surveys and keeps their finger on the pulse of what's going on around the world. I mean, how does that, bringing it back to the financial analysis, how does that affect your institutional decision-making?
Well, the one advantage of having been around for 200 plus years and in 100 plus countries is that you've kind of been through everything many, many times before. So we do have a playbook. And I think even though there's a lot of volatility, we will follow that playbook and it'll emerge as we go along. I don't think certainly for shipping, it makes that much of a difference how we make decisions, Brian, to answer your question. simply because I think it's an international business and we will have some volatility. Sometimes volatility is good for us. And we do recognize that shipping has on multiple occasions taken advantage of volatility to bolster earnings. But I think in this particular case, we'll have to see how it goes. Nobody can read really how things are going to play out. But I think for shipping and for our decision-making process, it's really business as usual, and we will continue to monitor the situation.
Right. On that volatility, I would suggest, again, I'm just a simple country lawyer, from everything I read and hear, that we are entering into a new interest rate environment, and that the likelihood is that interest rates only have one way to go, and it's probably not going to be down. So I think Paul made the comment earlier that financing is demonstrably higher. Having said that, I've seen a couple of very interesting deals over the past 24 months or so during the pandemic. As companies have become much stronger, it seems like they've refinanced their cap deck. And I think one of you mentioned Genco and Eagle, and those were particular deals I had in mind. Those are bigger, stronger companies, obviously, that everybody's aware of, and they have backing of public markets and the like. Do we anticipate, this is a multiple-pronged question, do we anticipate that will then, work its way through the system to, say, smaller, maybe less known companies? And I don't know, Martin, if you had any views on that.
Well, yeah, I think, again, the best and the strongest attract more capacity, and that drives margins in a certain way. And I think what I said was, if you look at the performance of some of the dry bulk companies and the container companies, et cetera, they have fabulous financial metrics, debt to EBITDA at record low levels, huge liquidity reserves, and that does drive margins. I don't think that's going to necessarily make its way into the smaller companies, et cetera. I think in general, we just see a much wider margin spectrum than we have seen in the past. And I don't think we're going to go back to, 10 years, 15 years ago type of margins, because the banks just can't afford it. We have very strict models for return on equity. We drive this, we run through these models all the time. We calculate, and it's going to be, and we stay very committed to follow those models. We are basically forced to follow the models, so that drives minimum margins. So I don't think so that we're going to see that go through to the smaller companies.
I'd agree with that, Brian, as well. Just on the question of cost of capital generally, something to keep an eye on at the moment. It's definitely what the Fed's up to with tightening, as you alluded to. I think we're seeing swap rates have moved on a 5-year basis, probably by around 50 basis points or more, just since December, between December and today, which could have a huge impact on the viability of the economics of a project. So shorter-term rates are signaled to increase. Longer-term swap rates have gone up, but they've stayed relatively flat. I think probably raises some interesting discussions that treasurers and CFOs just need to think about right now as it relates to hedging strategy.
Paul, I don't know. You I think probably have somewhat of a different business model than our other three panelists here. I wonder if you had any kind of different view on this, and you wear a couple of different hats throughout the industry as well. So.
Yeah, no, we do, and I appreciate that. Look, first of all, I find it interesting, when people talk about the container shipping markets and the dry bulk markets as being these robust cash cows, and as if they always were. It wasn't 6 months before this. I think half these companies were back at the table talking to their banks, and I think the one thing that people ought to be keeping in mind is who are your banks. Who are your relationships with? Because invariably you will be back at the table in those discussions. I think that hopefully, I know that folks like Eagle are very pleased with the results, and I think are now in a position to manage their balance sheet differently than they did in the past. But frankly, a lot of these companies had come out of bankruptcies only a few years before that. They had struggled in markets that were sub $9,000 a day, and continue to try and make a go of it. So look, I think it does give a new lease on life, and we'll see who actually utilizes that wisely. But frankly, you've got the tanker market still is struggling. It's interesting. I heard the cruise markets mentioned, because cruise is just bizarre. Because as difficult of a time as they're having, there seems to be no limit to the amount of cash they can bring in and equity they can raise. Anecdotally, we worked with one that frankly, after their first restructuring was going back to the equity markets, and they were looking for $1 billion, and the underwriters came back and said, well, how about two? So I think it's very different the way this seems. But I was very interested to see the acquisition of Ocean Yield. I will tell you that we see a lot more interest in these funds, in a lot of these European funds and U.S. funds backing these finance-oriented vehicles, and I think it is filling a gap in these banking and capital markets that have been left by the vacating banks. And Hafen obviously has been very successful in executing their model, and I think you're going to see more of that. What it means is a higher cost of capital, and frankly, by and large, you're still talking about an industry that only returns 7% year in, year out over a longer period of time. So it's a very, very rate sensitive and interest rate sensitive industry.
Well, I mean, does inflation, and I open this to the general panel, does inflation help that as a general premise? Will it help shipping get access to more capital, or will inflation hurt ship financing on a go-forward basis? Nobody wants to take that one?
I'll take. I think the more immediate, candidly, I think the more immediate issues are going to be some of these IMO or some of these carbon taxes. We'll see what that does in terms of pushing rates up. The general, look, the general goal is we'll make everything more expensive, so these other alternatives seem less expensive. So I think that this industry, like many, are going to be hit on a number of different fronts. But I think those are probably some of the more immediate issues that they're going to be dealing with.
Yeah, there's also a fundamental change, Brian, in the way that consumers are behaving now. I think we've seen the Great Resignation and all of that stuff. I think people are post-COVID emerging into a new relationship with what it means to consume. Not everyone, obviously, thank goodness. Otherwise, what would our ships be moving around? But there is a significant percentage of people who are reassessing, and I think the inflation aspect will drive more people to think about how they consume and what they consume. So supply is one thing, but I think the demand side is also being affected quite significantly by the specter of inflation. And then it becomes a self-fulfilling prophecy, because you have significant numbers of consumer companies already raising their prices, saying, hey, look, it's inflation and we need to keep up with it. So it just keeps feeding on itself, this animal.
Yeah, I think that, what my book says, that inflation is not favoring economic growth in the long term. So I don't think you're going to see a direct correlation between inflation and container shipping rates. But I certainly think that over time, if we have a slowdown in economic growth, that will be reflected in shipping. So definitely not a friend of inflation. Inflation is not a friend, I believe.
Right. Well, I mean, Paul just mentioned carbon tax too, and I'm going to coattail off a Lloyd's List panel I think I saw a week or two ago, where it was suggested that may or may not, there were different views, come into effect in the next, say, 3 to 5 years. I think we'd be remiss not to discuss, of course, something that goes hand in glove with that, which is just generally ESG on a broader base. I mean, my question as a ship finance lawyer is who's going to pay for this stuff? I mean, when the markets are okay for many of the segments like they are now, I'm thinking we're probably okay, but who ultimately, and I guess maybe bounce this maybe back to you, Shreyas, for a start off, if you don't mind, in that I know you guys are heavily involved in Poseidon principles. I mean, where's the money coming from for all these upgrades that are going to be needed in the coming years?
Where it always comes from. It's the final consumer. That's where it lands up. That's where it ends up. Every single thing that's on the shelves becomes more expensive, whether it's as a result of normal, quote unquote, inflation, or because ESG has layered on costs through the supply chain. But that's where it ends up. And it's a pertinent question. What happens in an environment where inflation is already high and then you're putting on ESG costs on top of that, right? And what does that do to demand? So that's for more experienced economists to answer. But the reality is it always goes down to the consumer. And that's what I've always said. It is up to banking to find the link between how to most efficiently connect the ESG cost that this industry has to spend with how that passes through the charterer and how that goes to the consumer, and whether a consumer cares that their product has had a green supply chain or not. I think you'll find that when it comes to people paying more for things, suddenly they stop caring a little bit less about the environment and decarbonization.
Sure. Well, Dan, I mean, I think sometimes you look at ship financing from a slightly maybe different perspective, and you consider it a bit more of a project and a much more long-term counterparty that you're relying on through charters and the like. I mean, did you have any views on that with respect to your model?
As it relates to ESG?
Yes.
I just think ESG is here to stay. The funds that have got capital to deploy have to meet ESG requirements and policies. I think they could help unlock shipping ultimately. I mean, if you look at what some of them have done. I mean, Brookfield raised a $7-8 billion fund, I think, that closed last July. It was a sustainability-focused fund. Maybe we have to try to do a better job in the shipping world, trying to attract some of that institutional money. I mean, if it's a sort of to Shreyas' point, a sort of $500 billion to $1 trillion type capex that we need to get through in the near term, then it can't be provided by banks alone. I mean, the number of banks that are lending does seem to be reducing rather than increasing. So the capital's got to come from somewhere. And I think if we can find a way to attract funds to invest in shipping through infrastructure funds, for example, who might be attracted to a long-term offtake contract with a credit-worthy offtaker, to your point, Brian, that would be the sort of situation that would really help my institution sort of get involved in more and more ship financing for sure.
And I guess, Paul and Martin, I mean, we've been talking about consolidation, I mean, since we were all in diapers. Will these financial factors ultimately push us towards the consolidation that we've been discussing for decades now? Will it finally happen in shipping?
Well, I think, I'll let Paul talk about consolidation, but I just think from the bank's point of view, right, we're already being charged for capital costs and liquidity premiums, and these factors are tightening. So the cost of providing lending is going up inherently. And I think the issue is if the ESG costs are allocated to the banks. I mean, we already have ESG costs because we already have a cadre of people that does ESG analysis on our clients, and they have to be paid for some way or another. And so I think if it becomes unprofitable to do ship lending, I just think the answer lies therein. Then we'll do less ship lending if it's not profitable. So at the end, the cost will have to be carried by the client, which has to pass it on to the consumer, or their charterer, which has to pass it on to the consumer. Otherwise, the equation won't go up. So it will be up to capitalism. But I just don't think the banks will be able to carry significant costs because we are already operating at an increased cost rate.
Yeah, so I think, first of all, I think shipping, people ought to recognize shipping already does a pretty good job. I think shipping moves about 90% of the world's cargoes for about 3% of the carbon output. So I think that, and I think the problem you have with the funds that are coming in and setting up the funds that are setting up capital pools for green initiatives and other initiatives, the problem is they're skipping right by shipping, right? They're going into wind farms, they're going to other things that are being seen greener. So they're not really helping the core markets. I don't think anything, look, we've all been in shipping for a long time. This is not going to crack the nut for consolidation. Shipping, as much as anything else, continues to be an industry that's driven by personalities, entrepreneurism, and I think that is one of the things that's been the most difficult thing. So when it's an industry that makes probably the most compelling argument for consolidation, yet frustratingly rarely happens, and I don't see this that's changing it. Having said that, I think that there's no doubt that these costs are going to continue to impact both the shipping companies in general. It'll have a follow-on impact on banks and so forth. But the reality is, look, until you get China, Brazil, Indonesia, India on board with these carbon issues and these things, I think that what you tend to do is you tend to focus on the things that are easy to focus on, but not really getting to the root of the problem. These are all, if the world wanted to change these issues, they could do it. But I think it's unfortunately to the point the number you've made, it's a painful process to get there, and ultimately what it means is that people are going to be paying more, which is something that they really don't want to do.
Right. What leads to the issue, our charter is willing to pay more as the middleman in order to, get the industry to where it supposedly needs to be within the coming few years. But we can spend, there's another ESG panel that's happening today, so we don't need to belabor that point. I guess one thing we'd be remiss about not discussing, maybe just a quick around the horn, maybe 30 seconds each, is, I have written and read and been very involved with lots of LIBOR and IBOR and SOFR discussions over the past 2, 3, 4 years now. And I know it's a particular interest to Martin. I mean, he loves this topic. I think it's a little bit of a primer for the non-finance people that are watching this panel. When they hear all these terms on a daily basis and they read about them in the different trade journals, it might be helpful for them to have an understanding of what we're all talking about all the time.
Okay, so well, the only way I understand things is to dumb it down. So because I'm limited capacity here, but the truth is, LIBOR is not going to exist. It has already been stopped. We cannot do new loans in LIBOR, and existing LIBOR loans will continue to exist until June 2023 unless they're refinanced or redone. So what are we quoting loans on today? Yes, we're quoting loans on something called SOFR. That is a risk-free rate that the Fed has convened a committee to come up with, and it's been between all the regulatory authorities, but basically it is a risk-free rate. Now, the difference between SOFR and LIBOR is that LIBOR is not a risk-free rate. LIBOR was the rate that banks were willing to lend to each other. So in LIBOR, there was a risk premium. So when we compare 3-month SOFR, because now we have forward-looking SOFR, which finally came through, that's fine. With 3-month LIBOR, the SOFR rate is less than LIBOR. So that is a challenge for the banks, because how do we then quote SOFR loans and have the same economic equivalent to LIBOR loans? So there has been studies done, and there has been come up with a credit adjustment spread between SOFR and LIBOR, and it varies like 11. It's an official spread. It's 11 basis points for 1 month and 26 basis points for 3 months. This is quoted by Bloomberg, etc. Now, the current challenge is that if you look at SOFR and LIBOR today, the difference is less than these spreads, because these spreads are in effect over the last 10 years, or 5 years maybe it was, but it's a historical number. However, it's supposed to capture the variation in LIBOR and SOFR going forward. So what we spend time on right now is how do we quote a SOFR loan to our clients? And some clients, they are okay with the spread, and others say they want a lesser spread because the market is less. But that's not we can't really go there, because at June 2023, a lot of trillions of dollars of contracts have been hardwired to change to SOFR and these acceptable spreads. So if we get to June 2023 and we have different spreads, our loans will then be off market. So it's a conundrum, but hopefully people understand the difference between SOFR and LIBOR is that SOFR is risk-free, while LIBOR had a risk premium in it. So hence, 2 different things.
LIBOR 101. Next time we'll do a full panel on just LIBOR alone. It sounds like a whole lot of legal work is going to be needed on this. So that's music to my ears. I don't know, Dan or Shreyas, did you have anything to add on the LIBOR point as bankers?
I can't beat Martin's comments there. Look, I think for shipping, just to round up, I saw the most incredible thing in the Financial Times over the weekend. One graph showing the profitability of container shipping companies against Netflix, Facebook, Amazon. I couldn't believe it. It was essentially a big applause round for the consolidation that happened in container shipping. So to the previous point of consolidation, I think that's what it can do when the timing is right. So let's continue to focus on getting some shipping companies together. I think that's the important lesson.
Great, thanks. Well, I think we're getting the hook, guys. So Dan, sorry. I do like to end these things on a positive note if possible. So if you can just in 10 seconds each, what are you most optimistic about over the next 12 months in shipping? And I guess, Paul, you went last first. So if you go first last, that'd be great.
Sure. Well, Brian, by the way, we've lost your picture. So if that was an attempt to as a positive, there you go. So look, I think these markets are resilient. I think that there's a lot of capital out there. It tends to find good deals. It tends to find industries to support. So I do think that there's going to be money there to support good projects. And so I think that look, I think that this industry for well-run companies is going to continue to find the capital it needs to grow and thrive.
Good news. Martin, anything? What keeps you excited about shipping, Martin?
Well, what's exciting about shipping is that 90% of the world's goods are transported on ships at one time or another. This industry is not going to go away. So capitalism will find, capital that to support activities. So I'm excited about that. I don't think, as Raj said too, we're very uncertain about the future, but I know there will be need for capital for shipping. So I'm very excited about it.
Well said. Dan?
I think putting COVID behind us, if we can, and just finding ways to work with these private capital, strategic investors, getting some deals done, finding new capital to bring into the industry. That would be top of my list.
And Shreyas, last but of course not least.
Well, two things: traveling again, seeing clients, and bringing in institutional capital into this industry. I think that's the need of the hour, as Dan has said multiple times.
I do indeed look forward to seeing you all very soon again in person. And thank you very much for your time and for attending today. Thanks to the Atlantic American and Norwegian American Chambers of Commerce, and of course to all of our sponsors for putting this together. It's been great fun. Thanks, guys. Okay, so we have very little time, and I understand we're running a bit behind schedule. So I think maybe if we could try to get one question to each panelist, I'd ask the panelists to please keep your responses to maybe 30 or so seconds if you could, so we can stay on schedule for the day. I guess, Dan, earlier on, you were talking about recourse and non-recourse and your business model at the bank. And I guess for our non-finance viewers, I was wondering maybe if you could just give a bit of a background on the difference.
Sure, no problem. Well, recourse deals tend to benefit from a corporate guarantee, normally from the shipping company that's borrowing the funds. Guarantees tend to be structured with covenants from the guarantor regarding gearing, leverage, tangible net worth. The idea is that the loan is safer with the entity's support and backing. And we complement all of that with traditional ship mortgages, of course, as well. On the non-recourse side of things, we don't tend to get guarantees. If we do, they're limited. So we structure the loan to an SPV, which owns ships, and it has associated cash flows attached to it, with the idea that we utilize those cash flows to amortize the loan. We capture the cash flows into an earnings account, and that's the source of funds for the repayment. We complement the earnings account typically with specific reserves, for example, to support OPEX, debt service, dry docking to the extent that the earnings dry up. And then the security package tends to have a heavy focus on the traditional ship mortgage, as well as assignments of key contracts. We can step into those contracts if the deal isn't working out as we initially envisaged. Now, finally, Brian, I'd say that the covenants are normally replaced with a debt service coverage ratio, and failure to achieve that results in the distributions being locked up to the sponsors that own the SPV, and can result in an event of default, for example, if debt service hasn't been made.
Thanks for packing that all into such a short period. Appreciate it. I think following on the same line of questioning, then Shreyas, I happen to notice that I think offshore is part of your title at Citi, and I was wondering how you view that in the context of wind and the growing market there. I mean, I always considered wind to be shipping. Some of my energy partners may disagree with me, but I was wondering about your thoughts there.
I think the test is really whether it's a floating asset, whether it's registered, and subject to maritime law. I think the mortgage and the ability to enforce should determine whether it's a shipping asset. If it's a power plant on land, I'm not going to go around claiming that it's a shipping asset, obviously. But a shipping asset when you see one, to paraphrase the Supreme Court. So I think the challenge is there. Is it an interesting market? Absolutely. It's going to be one of the fastest growing. It already is. It's evolving at a rapid pace because we are getting bigger and bigger turbines. There are more technological challenges to solve every day in this space. The problem is that the sector is still rather fragmented and nascent. We have short contracts. We have new assets being built to address the technological challenge. However, there is a question mark around completion risk and the yards that do this work, which all brings us down to, it doesn't fit into traditional shipping finance models. And so we need to put aside our normal playbook, the way we look at shipping assets, and think about this as an ESG challenge, stretch and finance these assets with a different mindset. And governments have a massive role to play in doing that, because without wrapping some of this risk in the ECA space, I think we won't get there.
Thanks, Shreyas. Paul, sticking on challenged segments or around the periphery of what we would consider traditional ship finance, we've seen quite the mess, I guess, over the past couple of weeks, continuing developments in Crystal Cruise's bankruptcy. I was just wondering if you think that's a one-off or if you see that kind of being more of a problem for the whole industry.
So if you're in this industry long enough, you've seen this stuff before. We saw it after 9/11 when we had the Renaissance bankruptcy. And from that, actually, AMA was part of creating Cruise Invest, which became Oceania Cruise and now part of NCL. So these things have happened before. I view this as more of a one-off. I think that most of the large cruise lines have taken this opportunity to recapitalize, have taken in a tremendous amount of capital. I think they're well positioned. And overall, I think the appetite for cruising seems to be insatiable. The demand never ceases to amaze me.
Well, that's good to hear. I mean, keeping with my theme of wanting to finish on a high note, then, Paul, you kind of threw me a softball for that. Going over to Martin, then. Martin, to quote you from earlier, you said there'll be less ship lending if shipping isn't profitable, I believe. I hope I didn't take that out of context. We've seen boom times over the past couple of years, I think, for, Janaeos came out with their earnings this morning. They were spectacular. I think Nakilat came out yesterday with their LNG earnings. We're seeing, great markets there. Based on that, do you see a more robust ship finance market as we progress throughout the year?
Yeah, I mean, we are thrilled to see profitability at our clients. I mean, that allows us to do more business, basically, because our models then reflect the strengthening financial status of the clients, and we compare well with other sectors in the bank that demand capital. So very, very thrilled to see these strong rates and these strong markets. Of course, we always experience shows that this is a cyclical industry, no matter what. But with the economic growth going on, consumption of goods, consumption of energy, where are goods being produced, etc. These factors are all, many of them are very positive, but they're hard to quantify. So we always then go back to our, look at.
I think we might have lost Martin. Sorry about that, but I think what he was probably going to say is if we hit $100 oil, the tanker industry will be the next to follow up. So I'll yield back to the moderators, and thank you very much.